Hello and welcome to this InvestEngine portfolio update, which is newly open, so it's more of an introduction really. And in this video, I wanted to give you an insight into why I chose InvestEngine as my new investment platform, the reason I've opened two separate accounts inside it, my investment choices for both these accounts, and why these are different investments to the ones I hold with different investment platforms. If you have watched other portfolio updates in relation to my Trading 212 and Vanguard accounts, you will know that I'm a fan of Vanguard funds and tend to invest in asset allocations of 60% equities and 40% bonds, as I believe that this aligns with my risk profile. Well, in this new portfolio, I've decided to do things a bit differently, with less exposure to Vanguard funds, less exposure to bonds, and a bit more exposure to high risk and volatile stocks. Before I get into my account, just want to quickly go through what's been happening in the markets in the last week or so. And significantly, it was announced last week that the UK rate of inflation went up by more than expected in January, with CPI rising to 3% compared to 2.5% in December, but where analysts had actually forecast a lower rise to 2.8%. This higher headline figure was largely driven by a bounce in airfares, higher prices in food and non-alcoholic beverages. Core CPI, which excludes the more volatile food and energy prices, increased by 3.7% year on year in January, up from 3.2% in December. And services inflation, a key measure of domestic price pressures, rose to 5% in January, up from 4.4% previously. On the 6th of February, the Bank of England had cut interest rates, bringing the base rate from 4.75% to 4.5%. This year, markets have warmed up to the idea that the bank could cut rates 2 or 3 more times before the year is out, in the face of slowing UK growth and fears of stagnation. But with inflation being sticky, higher employer national insurance contributions, and rise in energy prices likely to impact as we move towards the summer, the Bank of England's future decisions on lowering rates might have to be balanced against the backdrop of trying to keep a lid on the rising prices. Sticky inflation is not just a UK problem, with the US also announcing a small rise in inflation from 2.9 to 3% in January, where the target rate in both countries is 2%. I worry when I hear the words inflation and interest rates, as I have bond funds in my portfolio, as both these factors can have a negative impact on my bond fund's value. If either rise, then the value of bonds, especially if they're longer duration, will fall. But if interest rates and inflation continue longer term in a downward trajectory, then I hopefully won't lose too much sleep in the coming months. And the UK is not the only country in Europe to be suffering economic stagnation, with the EU also finding itself in a difficult economic position. With all that uncertainty caused by Donald Trump's threat of tariffs on Europe, the doubt about his commitment to the region, and a recent US pivot towards Russia, you would think that this would have caused uncertainty in European markets. But as of the weekend in 21st of February, the Stoxx European Total Market Aerospace and Defence Index saw rises of 15% so far this year, and the broad-based Stoxx Europe 600 Index has performed better than the S&P 500 so far in 2025. Closer to home, there's a similar picture, and looking at year-to-date figures, the UK's FTSE 100 Index of the largest 100 companies trading on the London Stock Exchange has also outperformed the S&P 500, so maybe it is not all doom and gloom. I recently published a video on whether now is the right time in 2025 to invest in the FTSE 100. So you might want to check this out after watching this video to see what you think. The best performing stock market in the weekend in the 21st of Feb was the Hang Seng, up 3.18%. And this was mainly fueled by a high profile meeting between Chinese President Xi Jinping and the country's leading tech bosses. During the week, the S&P 500 experienced losses of 1.71%, with the FTSE 100 faring slightly better with more modest falls of 0.84%. So moving on to my new InvestEngine account, you can see from the front page that I've chosen the DIY option for the two accounts I have opened. DIY means I just choose my investments for myself with no help, other than the general information that InvestEngine and the fund provider gives out in relation to the relevant fund. And doing things by DIY means that there is no platform management fees to worry about. If you are less confident or experienced, you can choose the managed option, where, after answering a series of questions, you are matched with a suitable asset allocation in line with your financial goals and attitude to risk. You then don't have to do anything else other than invest. This asset allocation will generally be a mix of stocks, which are seen in finances as a higher risk asset, and bonds, which are lower down the risk scale. When they are mixed together, if past performance is anything to go by, you will still get a reasonable return on your investment, but with less price volatility. InvestEngine has an annual management fee of 0.25% for this convenience, in addition to any fund ongoing charge figure OCF. And I will explain these OCF fund charges when I go through my choice of investments in this video. In real terms, if you had £1,000 invested in a managed account, you would pay £2.50 management fee per year, plus any fund charges, so this is pretty low. InvestEngine also have a set of ready-made blended equity bond funds called LifePlan Funds. Depending on what risk you want to take and what return you seek, these funds give you the option to dial up or dial down your bond allocation. So the LifePlan 100, for instance, would give you exposure 100% to equities to potentially provide you with the highest returns. Working down to the lowest risk, lower exposure to equities at 20% with the LifePlan 20, which would have 80% allocation to bonds. You again pay a 0.25% management fee for this convenience, with additional ongoing charge fees of any fund added to the cost. As an example, a LifePlan 60% equity fund with a 60-40 equity bond allocation comes with a total management fee of 0.25% plus the fund charge of 0.12%, giving a total of 0.37%, which is reasonable for a managed account and directly comparable with the fees of Vanguard's own blended life strategy set of funds. But what I like about InvestEngine funds, when comparing them with Vanguard's life strategy funds, is that they have less bias towards the UK and are generally more in line with what UK's market cap should be. Anyway, that's a subject for another video. I took the DIY option. So moving on to the two accounts that I've opened with InvestEngine. The first is a general investment account, GIA. This is a general account, so there are none of the tax benefits that you would get from an ISA or SIPP. I have none of that £20,000 ISA allowance left for 2024 to 2025. So I've opened this account to make room for cash that I currently have in savings, where I'm going to be liable for tax on interest earned. Opening this account therefore enables me to make use of other personal tax allowances that I have, such as capital gains and dividends. If you watch my Trading 2 and 2 portfolio updates, then you will know that I also hold a general investment account with them, so that capital gains allowance that I've already spoken about is already getting eaten away in that account. And I will need to get my assets moved from those general investment accounts into tax-efficient accounts in the next couple of years. But for the time being, opening this one is buying me a little bit of time and saving me from paying more tax on interest for the time being. My main reason for opening an additional GIA rather than using the Trading 2 and 2 account is to avoid the unlikely event of a broker going under and spreading my investments across different platforms to get that separate FSCS protection of £85,000 government backing for each platform. My main reason for opening a SIPP alongside the one I already have with Vanguard is that Vanguard currently charge a platform fee of 0.15%, whereas there are no fees with InvestEngine. I think that this is pretty groundbreaking. So my total fees for holding a SIPP with InvestEngine would just be the ongoing charge figures for the funds themselves, the cost of which I can control, as you will see when you look at my choice of funds in a minute. And it's likely that I'm going to transfer the pension and the ISA that I hold with Vanguard into InvestEngine at some stage. But I also wanted to open two accounts on this platform to conduct an experiment to see how much the SIPP will outperform the GIA, given that 20% government tax relief that I will get for anything I deposit into a SIPP. This is a great tax benefit of private pensions and will help you grow wealth tax-free faster than other accounts. And by how much this enhances the pension size over the coming months and years is yet to be seen. But I hope that you will stay with me on this journey to see how things pan out. For this experiment to work, I have of course had to invest in identical instruments across both accounts that I've opened. I now have direct debits set up, but to get things started, I paid £100 into these accounts a couple of weeks back, and immediately I was 25% up in the pension account with £25 HMRC tax relief pending. So what a great start. So this is my identical choice of investment for both accounts. The biggest position is 65%, and that is in the SPDR MSCI All Country World UCITS ETF with a ticker of ACWI, tracking the Morgan Stanley Capital International All Country World Index, which is one of the two main whole world indices alongside the FTSE All World Index. It provides access to roughly 2,700 large and medium-sized companies in the developed world and emerging markets, with a large financial provider assets under management number. I've picked this fund for its global diversity and its low cost, with a fund administration fee known as the ongoing charge figure, or total expense ratio, TER, of just 0.12%. It was 0.4%, so this is a great reduction in cost to a really competitive price. The OCF, or TER, is a specific fund charge for its administration, so would be in addition to any management or other fee if you were to go for any of those options that I mentioned earlier. Bearing in mind that where more expensive and less liquid emerging market stocks are included in the fund, the OCF is normally higher, with the OCF in some global funds pushing above 0.2%. And in my Trading 2 and 2 account, I invested in an emerging markets fund separately to save cost. But as this global fund here is already lower cost, including emerging markets, this is my preference. I want a small exposure to emerging markets to include countries such as India and China, as the companies in those countries could be the powerhouses of the future and are therefore worth taking a bet on in my opinion. And if you look at the analytics on InvestEngine, this fund provides just over 4% exposure to emerging markets, which, although being smaller than the 9 or 10% that many other world funds allocate in line with global cap, it is similar to the percentage exposure I choose in my trading 212 accounts, so it works for me. On the subject of analytics, I find InvestEngine to be really intuitive, and you can get a breakdown of just about anything you want, from what your exposure is to asset classes, regions, sectors, or individual holdings. And I'm really going to enjoy playing about with the analytics on this account. I have an asset allocation across all of my other investment platform accounts of approximately 60% equities and 40% bonds. But in this InvestEngine account, I've actually increased my exposure to equities to 75%, so now I only have a bond allocation of 25%. Bearing in mind that I have cash savings and guaranteed income from a public sector pension, I think in total, this helps to maintain a balanced portfolio in line with my risk preference, whilst enabling me to increase risk on this platform by investing in a more volatile fund, which I will talk about in a moment. I think this is sensible for me, but some of you may think I'm being too cautious, and I would be interested to know what you think and what your attitude to risk is, so please let me know in the comments below. And if you are enjoying the content of this video, then I would appreciate it if you would consider hitting that like button, subscribing to my channel, and to turn on notifications so that you'll be aware of when I post new content. The second biggest investment that I have, and the only one that's consistent across all of the investment platforms that I'm on, occupies 25% and is in the Vanguard Global Aggregate Bond Fund with the ticker of VAGS. And this fund tracks the Bloomberg Global Aggregate Bond Index. It's sterling hedged and has a low OCF of 0.1%. The fund size is very big and it uses physical full replication to track the index. This means that the ETF holds each bond in approximately the same portion as its weighting in the index. This bond allocation is to act as a buffer to smooth out the peaks and troughs of market price movements, as the price of equities and bonds tend to move in opposite directions under the same market conditions. But that's not always the case, and fast-moving inflation, for instance, could remove that hedge. The fund is diverse, investing in good quality bonds of different durations from different worldwide governments and corporations to try and get a reasonable return whilst managing some of the main risks associated with bonds. An example of this is that the fund will invest in longer duration bonds that are more risky as being more exposed to interest rate movements and inflation, and so should provide better returns as compensation for this. And the fund will balance this risk by also investing in short-dated treasuries that are cash-like and come with very little risk, so providing a lower return. And the final position in my portfolio, which occupies that remaining 10%, is for a more volatile and risky ETF, which is the iShares S&P 500 Information Technology ETF with a ticker for IITU. This takes the technology sector companies out of the S&P 500 index and puts them into an individually capped index to solely track the US technology sector. With US tech being the driver of global growth over recent years, this ETF achieved a fantastic return of over 32% in the last year and has a 5-year return of a magnificent 183%. It comes with a low OCF of 0.15% and is therefore good value, and I felt it was worth adding this as I believe that the US sector will continue to perform. The question is for how long, as tech stocks are already expensive and you have to consider how much more values can rise. Although a seemingly diverse collection of 71 companies, the ETF is heavily concentrated on the top 3, with Apple, Microsoft and Nvidia taking up about 57% of the fund. This increases my overall exposure to tech stocks generally, and those top 3 particularly, as they also form the biggest part of the global fund in this portfolio. With reduced diversity comes higher price volatility. The standard deviation volatility measurement that is provided by Morningstar shows how volatile this fund is at over 23% when compared with the more diverse global fund ACWI at just under 11%, with a higher number meaning that the stock is more volatile. But this ETF only occupies 10% of my InvestEngine accounts and is a much smaller percentage of my portfolio in total if you look at it across all accounts. And when taking all 3 funds in this account into account, including that bond fund, the volatility will get watered down to a more diverse picture in any case. So IITU is something I'm happy to include for the time being as a more risky, volatile, but small satellite position. As I've only invested the first deposit into IITU so far, you can only see the exposure to individual tech holdings that the ETF on its own provides in my portfolio. But the next video will provide a more accurate picture of portfolio balance when my monthly saving plans of £200 into each account kick in on the 10th of March. Both accounts are set up to automatically invest the money across my 3 funds in the correct proportions. By also turning on Autoinvest, any spare cash sitting in my account will automatically get reinvested and not just sit there being dormant and not doing anything. Autoinvest is especially useful in the case of distributing funds. where dividends get paid to you into your cash account rather than being automatically reinvested back into the fund, as is the case with the accumulating ETFs like the three I've chosen in the InvestEngine portfolio. This is my deliberate choice to make things easier and more efficient. Well, there it is, my very first InvestEngine portfolio update. I hope this talk through was useful and interesting for you, and I hope that you will continue to follow me on this journey as I continue to conduct the experiment into how much a SIPP outperforms a general investment account. I hope very much I'll see you in the next video, and thanks very much for watching.